What if your investments didn't just sit there in a digital vault, passively waiting for the market's unpredictable tide to lift their value? What if, instead, they were active employees working for you around the clock, tirelessly generating a steady, predictable stream of income completely independent of their day-to-day price fluctuations? This isn't some futuristic financial fantasy. It is the multi-trillion-dollar reality that BlackRock, the undisputed 800-pound gorilla of global finance, is now aggressively pursuing. In a move that could either unlock a revolutionary new era for mainstream crypto investors or see them crash headfirst into an immovable wall of regulatory rejection, they have thrown down the gauntlet. In a bombshell 19B4 filing that has ricocheted through the corridors of Wall Street and the decentralized forums of the cryptosphere, BlackRock has officially petitioned the United States Securities and Exchange Commission, the nation's formidable financial watchdog, for permission to add a radical and powerful new engine to its already blockbuster spot Ethereum ETF, staking. Today, we are going to conduct a forensic deep dive into this high-stakes power play. We will break down exactly what this cryptic-sounding staking mechanism truly is, why it represents a fundamental paradigm shift in the very philosophy of investing, and how it could potentially supercharge an already explosive and rapidly maturing market. In this episode, we will uncover why BlackRock is engaged in a frantic, high-speed race against other financial titans like Fidelity, Grayscale, and 21 Shares to be the first to crack this complex code. We'll follow the absolutely mind-boggling trail of money, billions upon billions of dollars, that is already flooding into these new crypto products, and explore precisely how the addition of staking could blow the financial floodgates wide open. And most critically, we will confront the giant lurking in the shadows, the immense and nuanced technical risks, and the looming make-or-break regulatory battle that could doom this entire enterprise before it even begins. Is this the moment crypto finally graduates, putting on a suit and tie and taking its seat at the main table of global finance? Or is it a dangerous bridge too far for the world's most powerful financial gatekeepers? So first things first, let's demystify this term that is set to become a household name for investors: staking. For many years, the primary strategy to profit from digital assets like Ethereum was brutally simple: buy low, hope to sell high. It was a speculative bet on future appreciation. Staking, however, completely rewrites that rulebook. The best way to understand it is to think of the Ethereum network not just as a currency, but as a massive, decentralized global supercomputer. To keep this worldwide computer secure, honest, and running smoothly, it needs a legion of participants to constantly audit and validate the transactions flowing through it. To become one of these trusted validators, you must stake your own Ethereum tokens, essentially locking them up as a security deposit or collateral. This is your skin in the game. It proves you have a vested financial interest in maintaining the network's health and integrity. In return for performing this crucial digital service, the network automatically rewards you with, you guessed it, newly created Ethereum. It's a yield. It's a dividend. It is an income stream earned simply for contributing to the network's operation. This is the core of Ethereum's proof-of-stake system, a far more energy-efficient model than Bitcoin's proof-of-work, which appeals greatly to large ESG-conscious institutions like BlackRock. Now, imagine this incredible power harnessed by a firm that manages assets equivalent to the GDP of entire nations. BlackRock's proposal, submitted for their iShares Ethereum Trust, trading under the ticker ETA, is to take a significant portion of the vast pool of Ethereum held by their ETF and put it to work through this staking mechanism. The legal language in the filing is both direct and audacious. It seeks to methodically remove all previous restrictions against the practice, explicitly stating that the trust would receive all or a portion of the staking rewards, which would then be treated as income for the fund's investors. This is nothing short of a seismic shift. It transforms an ETF from a passive, mirror-like vehicle that simply reflects the price of Ethereum into an active, productive, yield-generating machine. It's the profound difference between owning a gold bar that just sits in a vault, its value inert, and owning a magical goose that lays golden eggs every single day. For the average investor holding shares of this ETF, this means their investment could potentially deliver positive returns even during periods when the price of Ethereum itself is stagnant or even declining. It introduces a powerful, attractive new dimension to the risk-reward calculation, making the product infinitely more compelling to a much broader, more conservative base of investors who have been starved for predictable income streams in a low-interest rate world. And make no mistake, the market's appetite for these products is already beyond ravenous. The launch of spot Ethereum ETFs has ignited a firestorm of interest, signaling a definitive turning point for the mainstream acceptance of digital assets. We are witnessing an unprecedented, historic surge of institutional and retail capital. Let's put the numbers into perspective, because they are truly staggering. BlackRock's ETF fund, standing alone, has already attracted a colossal $7 billion in net inflows. To be clear, that is more than double the combined amount pulled in by all of its nearest competitors. It is a staggering display of market dominance. Looking at the broader ecosystem, the entire fleet of new Ethereum ETFs recently enjoyed a spectacular 9-day streak of consecutive positive inflows, collectively funneling over $2.2 billion into the asset in less than 2 weeks. At the absolute peak of this investor frenzy, the market witnessed a record-shattering $726.6 million pour into these funds in a single 24-hour period. This isn't just a fleeting trend. It is a tidal wave of capital reallocation. And now, into this superheated environment, BlackRock wants to inject the high-octane fuel of staking. By offering a stable yield on top of the potential for price appreciation, they aren't just sweetening the deal, they are fundamentally re-engineering the product's very DNA. It would become a unique hybrid asset that offers both the growth potential of a tech stock and the income generation of a dividend stock or a bond, the absolute holy grail for modern portfolio managers. This move is also a brilliant strategic checkmate in a high-stakes chess match for market supremacy. BlackRock is not operating in a vacuum. Other industry behemoths, a veritable who's who of finance, including Fidelity, Grayscale, and 21 Shares, are all scrambling down the exact same path, filing remarkably similar proposals with the SEC. The race is officially on, and the ultimate prize for the winner will be the exclusive right to be the first to offer this enhanced, yield-bearing version of a crypto ETF to the public, potentially allowing them to capture a dominant, near insurmountable share of a market that is already valued in the tens of billions and is growing at an exponential rate. The sheer scale of this financial transformation is breathtaking, and we are privileged to be watching it unfold in real time. It represents a monumental clash of old-world financial principles and new-world decentralized technology. If you're finding this detailed breakdown of the market mechanics and power plays as fascinating as we do, please take just a second to hit that like button below. It's a small click for you, but it serves as a massive signal for us to continue digging deep and bringing you these crucial, in-depth stories. However, this golden vision of effortless, automated yield comes with a formidable dark cloud of uncertainty and profound risk, and at the center of that storm is one all-powerful entity, the SEC. The inclusion of staking within the highly regulated framework of an exchange-traded fund has long been a deeply contentious issue for regulators. On one hand, the SEC has a mandate to foster innovation and capital formation in U.S. markets. On the other hand, its primary, non-negotiable mission is investor protection, and staking introduces a whole new Pandora's box of complex dangers that simply do not exist in traditional ETFs that hold stocks or bonds. Let's talk about the biggest boogeyman, slashing. It sounds violent, and in the unforgiving world of digital protocols, it is. As we discussed, staking requires validators to perform their duties flawlessly. If a validator, managed by or on behalf of the BlackRock ETF, makes a critical error, such as going offline during a key validation period, accidentally processing a fraudulent transaction, or otherwise violating the network's strict rules, the Ethereum protocol can automatically and programmatically penalize them. This penalty involves slashing or destroying a portion of their staked crypto. That staked crypto, of course, belongs to the fund's investors. A single technical error or malicious act could therefore lead to a direct, permanent loss of the fund's underlying assets, irrevocably destroying a piece of every investor's capital. Then there's the risk of network outages or undiscovered bugs in the code, which could disrupt the staking process and halt the flow of rewards. Critics also raise very serious concerns about liquidity and opportunity cost. The staked Ethereum is locked up for a period of time. It cannot be sold instantly on the open market. Imagine a scenario where there's a sudden, sharp market crash, and the fund needs to liquidate assets to meet a wave of investor redemptions. If a large percentage of its holdings are locked in staking contracts, it might be unable to do so, creating a potential valuation and liquidity crisis. These are not trivial edge case concerns. They strike at the very heart of what an ETF is supposed to be: a liquid, stable, and transparent investment vehicle. The SEC's monumental task is to weigh the tantalizing potential for enhanced returns against these very real and complex risks of capital loss, illiquidity, and even the long-term risk of market centralization if a few huge staking entities like BlackRock and Fidelity gain too much control over the Ethereum network's validation process. Of course, proponents argue that these risks are manageable. They insist that by using professional, highly reputable, and insured staking providers, and by diversifying the fund's staked assets across hundreds or even thousands of different validators, a fund of BlackRock's scale can effectively mitigate these dangers and deliver a consistent, safe yield. But the final, binding decision rests with the 5 commissioners of the SEC, and their long history of measured, deliberate caution suggests this will be anything but a simple rubber stamp approval. So, what are the realistic odds? When could we actually see a staking-enabled Ethereum ETF become a tangible reality for investors? While the SEC maintains its characteristically cautious public posture, the sheer, relentless volume of filings from nearly every major player in the asset management industry is creating immense pressure for the agency to forge a clear and predictable path forward. They cannot ignore this groundswell of demand indefinitely. And this is where the seasoned experts and analysts come in. Bloomberg analyst James Seifard, one of the most respected and closely followed voices in the ETF space, has offered a surprisingly optimistic forecast. He projects that the SEC could grant approval for staking functionalities by the 4th quarter of the year 2025. That is a very specific and notably bullish timeline, suggesting that behind the closed doors of regulatory agencies and corporate law firms, the necessary groundwork is being laid for eventual acceptance. This timeline would conveniently land well ahead of BlackRock's own final deadline of April 2026, giving them ample time to prepare their launch. Seifard's prediction reflects a growing consensus that the regulatory environment, while painstakingly slow and deliberately methodical, is undeniably evolving. The SEC is being dragged, step by step, into grappling with the complex realities of crypto as a fully fledged, maturing asset class. The approval of the spot Bitcoin ETFs was the first revolutionary step. The subsequent green light for spot Ethereum ETFs was the second. Approving staking would represent the third and perhaps most significant leap of all, as it would be an implicit acknowledgement that these digital assets are not just speculative commodities, but are, in fact, productive, functional, and essential components of a new financial infrastructure. The regulatory decisions that are made over the next 18 months will undoubtedly set the precedent that shapes the future of digital asset investment for the next decade and beyond. To ensure you stay ahead of this rapidly evolving story, and don't miss our critical updates on the SEC's final verdict and what it ultimately means for investors around the globe, make absolutely sure that you are subscribed to the channel and have those notifications turned on. You truly will not want to miss how this monumental story ends. In conclusion, BlackRock's audacious proposal to weave staking directly into the very fabric of its spot Ethereum ETF is far more than just a minor product enhancement. It represents a pivotal, historic moment, a strategic gambit designed to fundamentally redefine what a crypto investment can be and what it can do for a portfolio. By aiming to unlock a new, consistent, and powerful stream of yield through direct, active participation in the blockchain's security and operation, the fund could offer a potent, dual-engine return to investors, elegantly combining the potential for long-term capital appreciation with the stability of short-term income generation. This move is setting a bold new precedent for the entire asset management industry, aggressively pushing the boundaries of what is possible within the safe, regulated confines of traditional financial products. The anticipated regulatory approval within the next year and a half underscores a profound and irreversible shift: the growing institutional acceptance of crypto's core, productive functionalities, moving far beyond its initial reputation for pure speculation. Market participants, from the largest sovereign wealth funds to the smallest retail investors, should be watching the SEC's every move with bated breath. These decisions will not only determine the fate of staking-enabled ETFs, but will also signal the broader trajectory of crypto's deep integration into the global financial system. The game is changing right before our very eyes. The defining question is no longer if traditional finance and decentralized technology will merge, but how fast and on whose terms. And with this bold, decisive proposal, BlackRock has made it unequivocally clear that they intend to be the ones holding the pen, writing the rules for the next chapter of